Hi and welcome to the Day Trading Mentor. What we're going to talk about in this video is give people an introduction into what the price ladders are in futures trading. The price ladders are also sometimes referred to as depth of market or DOM for short, which I'm sure you've seen spoken about on various internet forums. This video is aimed at people that are fairly new to trading, people that are perhaps trading Forex at the moment, and have read some of my other material about why you shouldn't be trading Forex and how professional futures traders really trade. So what we have in front of us are two price ladders. On the left here we have the price ladder for the German Bund, which is a futures contract for the German 10-year government bond. This is a huge market that's heavily traded in Europe. And on the right here we have what a lot of my American customers will be familiar with, the E-mini S&P. So these are a couple of ladders. Obviously from your trading software you can get up any market in the world, and they'll all be displayed on a price ladder such as this. Now, why is it called a price ladder? Obviously we can see that each of these price levels, it kind of looks a bit like a ladder. We have different rungs on each price, as you would on a rung of a ladder. I'll just start off by going through what each of these columns mean. On the left hand side here, all these numbers in blue represent the number of contracts that are being bid by market participants at that particular price. So for example, at this price of 147.34, there's currently 461 contracts bidding. Now that isn't 461 traders. That could be one trader that's got a 200 lot, another trader that's got another 200 lot, and then a few smaller traders making up the rest of the balance. We don't know that, and it doesn't really concern us too much. Obviously in the middle we have, these are all the different prices that the market can possibly trade at, but where the market is actually trading at the moment, we can see all the bids on this side, and on the right hand side these are all the offers, and where the bids and the offers meet, that's where the current market is. So we can see the current best bid, which is the highest price that any market participants prepared to buy the market currently, is 147.36, and that's how professional futures traders make a quote in the market. Obviously somebody new to trading would say, oh, that's 147.36. We just say 147.36, and that's how a broker or another trader would expect you to talk to them. So the best bid is 147.36. The best offer in the market, we can see there's 400 contracts or so being offered at 147.37. So what drives this market up and down? Obviously supply and demand. So when you have the bids and the offers meeting in the middle, nothing would actually happen until you either have an aggressive buyer or an aggressive seller that wants to move the market. So we can see here the market was 147.36 bid, it's now 147.36 offered. It's now 147.35 offered. We can see it moving down this ladder. So what made the price go down? Well, somebody that was working an offer and running the risk of not getting filled, you only get filled on an offer if a market participant buys from you. So if you're working orders to sell in the market, i.e. an offer, you need somebody to buy from you for you to get filled. And likewise, if you're working bids in the market, you need somebody to sell to you before you can get filled. So what's pushing the price down at the moment is aggressive sellers will be saying to the bids in the market, okay, I'll sell to you. So this column here on the outside shows us the number of contracts that have currently traded at that price. So this 262 contracts have currently been sold into this bid. Now there's 114 bidding, roughly, call it around 100. Obviously the numbers are always changing as people are putting their orders in, pulling their orders out. It would take about 100 contracts sold down there, which happened, to push the market down. Likewise, to push the market up, people would need to buy 400 or so contracts and take all those offers, and that would push the price up. So I can be working bids and offers in this market like this. So you can see a scattering of orders that I put in the market. We've got our bids down here and our offers up here. We haven't been filled on any of these. We haven't been executed on any of these trades. See, my best offer is 147.41. Now I wouldn't be able to sell that price until all these contracts have been bought up at all of these prices and it gets to me. So this is where the competitive element of supply and demand comes in. Somebody that's prepared to be an aggressive seller will work an order closer to the market, and somebody that's an aggressive bidder will work closer to the market on this side as well. So let's get a trade on and show an example. But actually, before I do that, I'll just explain to you what first in, first out means, which is basically a queuing system. So say, for example, this price here of 147.33. If I was to put my bid in this market, as I explained before, these contracts would have to be sold to, these contracts would have to be sold to, before I can start thinking about getting filled at my price here. But because I put my order in at the back of these 600 contracts, it works on a first in, first out basis. I will need that price to trade 600 contracts because I'm at the back. So it's got to fill all the people in front of me before I get filled. So let's try and get a trade on here. Let's try and buy this market. So I'm currently working to buy one contract here at 147.35. There's about 150 contracts bidding at this price, and I'm probably fairly near the back of that. So I'm waiting for a couple of hundred contracts to sell down into this price for me to get filled. Now there's a chance I might not get filled on this price. The market could start going up without me actually getting filled, and I'll explain what happens and how we can avoid that in a minute. So we can see 13 contracts just traded down. That'll move me 13 contracts closer to the front. Had some more contracts trade down. A total of 26 contracts now. Now 40 in total have traded down. And there, we're filled. So we're long the price, i.e. we have bought 147.35. Now notice we've bought this price and we never paid any spread on it. Now those of you that have traded Forex before, you are always paying a spread. You are always having to jump across and take the next best offer. I was queuing on the bid and we can see the market going up in our favour. So I've bought at 135. Now I can try and work an offer here at 147.37, and if I get that price, I would have made 2 ticks. Bought at 35, sold at 37, that would be 2 ticks profit. Now in the Bund, every single tick to me is worth 10 euros for every contract that I trade. So I've only bought one contract, as you can see from this number 1 here. So if I get this price at 147.37, I would have made 2 ticks on one contract, so 20 euros profit. So let's see what happens. Obviously, because I've bought to close out this position, I need to offer it to sell, and that will get me flat. Flat means no position. So 147.36 is the best bid at the moment, 147.37 the best offer. It's currently 400 on the offer, 400 contracts working to sell, and I'm probably about 300 or so back in here. So working a bid to get filled and working an offer to get out is called working an order. You're not going straight to market. I'll show you what happens when you go straight to market when I close out of this trade. Just a little tip. I knew I was going to get it then, because the S&P is a stock market and the stock market's dropping at the moment. You can see, you can't even see any bids on this screen because it's moved down unless I recenter it. And when the stock markets go down, bonds tend to go up. So I had a feeling that market was going to rise. But so lots of little pieces of information and nuggets of wisdom from my experience you can learn about on my website. So just to summarise, we bought at one price, we were working a bid, people traded down to us, gave us our fill, then the market went up and we made 2 ticks on it. And we can see here in our fill window, which shows us all our trades, we bought one and we sold one. We bought at 147.35 and we sold at 147.37 and we made €20 profit off of that. Obviously, on my website in the members area, I'll teach you actual strategies of how we know when the market's going to go up and how it's going to go down. Now, I only bought 1 contract. If I'd bought 2 contracts, that would have doubled my profit. 3 contracts trebled, and so on. When you get experience at trading, you can trade comfortably, I'd say about a 5 or a 10 lot in this market. So that would be 50 to 100 euros for every tick that you made. If I was trading a 10 lot, and I just made 2 ticks, I would have made 200 euros off of that trade just then. But that's something we can all build up to. But you don't need to worry about that too much just yet. The techniques that I'll be teaching you involve lots of low risk, high probability trades where you're looking to make 30 or 40 euros on every single trade on very small size, which you can do at home. And if you're doing that 10 or 20 times a day, you're making 200 or 300 euros or dollars, whichever currency you're trading in, per day for yourself. And I'll be showing you exactly how I've done that as a professional trader for years. Okay, so moving on with the material anyway. What we did here was we were working a bid, as you remember, and we worked an offer to get out. Working an order is a passive way of getting in because you're hoping somebody gets filled. You're hoping somebody fills you. Now, what you can do, as I said before, in order for the market to move, you need aggressors. You need people willing to buy at market or sell at market. So here we can see at 147.36, there's 123 or 113 now offers willing to sell. Contracts that are on the offer willing to sell. Now, they are looking for somebody to buy from them. And I believe the market is going to go up. For example, if I thought the market was going to go up, I can just click on this side and I can buy from one of these people that are willing to sell. Likewise, if I think the market's going to go down, I can see there's you can just see the market moving down, 100 people traded. Okay, so 147.34, there's 400 contracts here that are willing to buy. Now, if I thought the market was going down, I could do what's called hit the bid. So I could sell to one of these people and I would instantly get in the market. There's no risk of me missing that price. So remember, we can lift the offer, which means take a price from one of these people offering to sell if we think the market's going to go up, and we can hit the bid if we think that the market's going to go down and sell to some of these contracts that are bidding here. So let's say I think the market's going to go down and I'm going to sell. We can see 54 contracts have just sold down into this and I'm going to sell another one there. This shows that there's a total of 55 that were traded. So I'm now short 1 contract. I'm short at a price of 147.34. We can tell I'm short because this box is red. This box was blue before when I'd bought the market. Okay, so I've sold this price, which means that the market needs to go down for me to profit. Now the risk of working an order, for example, if I'm working an order here, is that nobody trades up and fills me and the price could get away from me. But you eliminate that risk by just hitting the bid or lifting the offer because you trade immediately with the best market price. But as you can see, the price is currently bid against me. If I wanted to instantly get out, I would have to lift this price here, buy back my position at 1 price higher, and I would have lost a tick. That would have cost me 10 euros. Now, when I got in the first time, remember, I was instantly long the bid. So I had size to lean on. The equivalent would be to be short the offer. If I had sold this price here, I could be short from 134.35 at a better price. But because I went straight to market, I guaranteed I had that price, but it looks like a worse price now because I've sold into the bid and there's people still bidding at that price. So I need another 800 or so people to sell at this price as well to start moving the market down in my favour. So let's see what happens. We can see a total of 423 people have currently bought this price, and now 50 people have just sold this price. So we need another 750 people at least to sell at this price to start pushing it down in my favour. So you can see it's far more preferential to get filled by working on the bid or working on the offer. "37 contracts just bought." We can tell that they bought because it's gone green. If they sell, it goes red. That 398 people sold and took the price offered. The price is now moving down in our favour. Now obviously, because I've sold this market, or I'm short this market, I need to buy it back to realise a profit. So before, to close out my trade, I worked a bid, and I hope that people traded with me. Sorry, before, I was long before, so I was working an offer. So to get out of this, I'd need to work a bid. But I'm going to show you about trading at the market again. So to close out, there's 100 or so contracts willing to sell at 133. I've sold at 134. Oh, I missed it, it's just gone bid. Okay, I think that's going to be a winner, but for example's sake, I'm going to lift the offer at this price here, and I've closed my trade because I bought from one of these people that were willing to sell. So I sold at 147.34 and I bought back at 147.34, so I broke even on that trade. That's called scratching a trade in sort of trading lingo. And we can see our P&L still reads €20, even though we've now bought 2 and sold 2, which were our 2 trades. So just to recap what we've learnt so far, all these numbers on the left are the number of contracts willing to buy at these various prices. So there's 795 contracts willing to buy at 147.28, 460 willing to buy at 147.32, and so on. And on the right hand side we have all the contracts that are willing to offer. 485 willing to offer at this price of 147.36. To get filled, if I put bids down here, I'm not going to get filled until the price comes down and trades with me. And if I work offers up here, I'm not going to get filled until the price moves up and trades with me. To stand the best chance of getting filled, I've got to work an order right next to the market and hope that these people that are currently buying and selling to each other have enough buying or selling pressure to fill me at that price as well. There's 2 ways to get in, as you know. We can work an order and hope somebody trades with us, or we can instantly lift an offer or hit a bid, and that means that we trade with the counterparty that's currently in the market. Now, for somebody that's just starting out in trading, I know that this is probably quite a lot of information to take in, but I promise you this is second nature after you've had a play around on a demo account. For literally half an hour, this will all make sense to you. I've been trading 12 hours a day for the last 8 years or so, making a full-time living from trading, and I can tell you it's just instinct how quickly you can move the mouse around and get in and out, and it all makes perfect sense. You just have to remember this is like a never-ending electronic auction. People are saying I'll buy at this price, people here are saying I'll sell at this price, and when buyers and sellers overwhelm each other, they push the price up or down. I just want to make a few comparisons to forex trading or foreign exchange trading, which I'm sure any of you that have a tiny interest in the markets have heard about, because the forex companies are the guys that have the biggest advertising budgets. But I can assure you that the professional trading industry, I've been a proprietary trader, which means I trade my own money through large clearing houses in London, The professional trading industry all trade futures for many reasons. Firstly, as you can see this ladder, we can see exactly what volume people are working on all of these prices, which is a huge advantage. We can see there's some big orders down here. There's nearly 3,000 people want to buy at this price, so we know when the price starts getting down there, something's going to happen. It's either going to take a huge sell order to push this through, and if that happens, there should be a big down move. But we could maybe buy in front of this and protect ourselves by leaning on this size a little bit. In Forex trading or foreign exchange trading, you don't get to see any of this information. Only in futures, because the futures market is a transparent exchange where everybody has to execute their orders through this, and you can see exactly what's happening. You can see the quantities that people are buying or selling in the market, and also we have the luxury, we can work on the bid and work on the offer, so we can get filled sometimes without the price even moving. The price could still be 34 bid, 35 offered, and we get filled on the bid or the offer just because a few people trade up or down. But when you trade Forex, you're always quoted a spread. So euro dollar, for example, might be 33 bid at 35 offered, and you would have to always buy at 35 and always sell at 33. So you're always going to be 2 ticks offside as soon as you get in the market. To be fair, euro dollar is probably about half a pip or 1 pip spread, but something like dollar yen or sterling dollar, you're looking at a couple of pips, as they call it in Forex, or ticks, which is the minimum price movement, just to get in or out, and that's going to cost you an absolute fortune over the long run. Whereas with futures trading, you can get in and you pay commissions, but it's a couple of dollars to get in or out. And worst case scenario, you're going to have to pay it one price worse. And that sometimes happens, but the amount of times you can buy on the bid or sell on the offer and make the market yourself, you're saving yourself, well, obviously it depends how much you trade, but you're saving yourself potentially thousands in a year. I would typically do about 8,000 trades a month, or trade 8,000 contracts in a month. And you think I'm saving myself 2 ticks every time I trade, that's a huge saving that you're making. Just to example, every time if this was a Forex market to buy, I'd have to buy at that price, sell at that price, sell at that price, buy at that price, always giving up a tick. Whereas in futures trading, you don't have to. Obviously, this is a very basic overview. There's so much information here that you can read when you're skilled and equipped. Obviously, by watching and analysing how these orders are changing, we can predict where the market's going to go, and that's exactly what I'll be teaching you at thedaytradingmentor.com. These markets are controlled by computer algorithms. I'm sure you've read a lot of articles on the internet about how high frequency trading and algorithms are dominating the market and making it hard for a retail trader, and that's true to an extent, but we can learn to spot what these algorithms are doing, and that's how I've made a living for the best part of a decade, trading futures. And this is how professional traders really trade. You don't have technical analysis where you're looking at a level in the market or a moving average or stochastics or any other technical indicator you probably read about or somebody's tried to sell to you on an overpriced trading course. Professional traders, we glance at it, but all the information you need is in this ladder. And when you can learn to read what's happening in the order book here, you can start to predict with pinpoint accuracy what the market's going to do. For example, if I had a view on the market that I thought it was going to go down, I could be watching patterns that I know to look for as it reaches each of these prices, and I could get in with the maximum risk of just 1 tick, because I know as soon as that price was traded through, I'd be wrong on the trade, and I can get out for a scratch, so risking zero money, as you saw in that previous example, or a 1 tick loss by just hitting the next price. Whereas with technical analysis or Forex, you're looking at least 5 or 6 ticks of risk on every single trade. Whereas when you know how to read the price ladder, you have precision entry with 1 or 2 tick stops maximum. And likewise, yes, you can look to run trades a long way and have your 10, 20 tick winners, but to be honest, you don't need to. It's all about making the cash register ring, getting in, getting out, risking perhaps 0 ticks on a trade, looking to make 2 or 3 ticks on a trade, and over the course of a trading day, that adds up, and it's very not easy. You need to be educated, but it's very achievable to be making 20 or 30 ticks a day, and it's 200 or 300 euros or dollars, whichever part of the world you're based in, and that, believe me, that adds up at the end of the month. So, as always, if you've got any questions about this, please go to thedaytradingmentor.com, and you can send me emails. I've got an email address there just purely dedicated to helping out people that want to learn to trade. There's loads of information that will get you up to speed with what the futures industry is, what to look for, what not to look for, more information on the price ladder. And for those of you that would like to make some good money from trading this, hopefully as a start off as an amateur, then move to full time, and then I've worked with people that have gone on to manage funds. So the sky's the limit. You can start off trading one contract, which I've been doing just here in this example, just one contract. But you can very quickly start working a 5 lot here, which is 50 euros every single tick. You don't need to be making a lot of ticks in a day for that to really add up. So I hope I put forward a good case why you should be trading futures and not Forex. I hope that you've learned about what the price ladder is and how the bids and offers interact with each other. And any more information, get in touch. Yeah, sorry, there is one other thing I was going to mention. The software I'm using here is TT, which stands for Trading Technologies. This is kind of the industry standard for professional traders. It is quite pricey if you're new to trading. I don't recommend you using this software until you're getting to a stage where you're making a couple of $100s a day for yourself. But there's plenty of other software that shows exactly this information. This software is just a little bit more refined, but things such as NinjaTrader, it has a pretty reliable price feed, and you can see all this data on there as well. So speak to your broker. Provided it has a price ladder, that's what you need to get you going. For now, the next steps, I recommend signing up for a demo account with a broker, getting a feel for the ladder, how all the bids and offers move, and then if you're comfortable with it and you think it's something that is appealing to you, we can move on and start learning some strategies that are actually going to make you some decent money. So I hope this helps, and feel free to get in touch.